Over the past 12 months, shares of American Railcar Industries Inc. NASDAQ, ARII, are up about 4%. In my view, there's still time to buy, as price is still below value. I'll go through my reasoning behind a bullish call here by looking at the recent financial history and by modeling a reasonable dividend expectation. I'll also focus in on the stock itself, and I'll conclude with an interesting option strategy on the off chance that my case isn't compelling enough and potential investors remain too nervous about committing fully at these levels. Future demand for railcars. Before getting into the weeds of the American railcar analysis, it would be worthwhile to spend some time going over the environment in which it operates. In my view, the company's operating environment could best be summarized as being fairly volatile in the short term but showing some very positive demand growth trends over the coming decades. On a long enough timeline, it's fairly certain that freight demand will increase relatively robustly, and more stuff will be moved by rail for a host of reasons. Chief among these is population growth. Additionally, while there are many variables at play, it's reasonable to suggest that the demand for the two types of cars that American Rail produces, covered hoppers and tank cars, will remain relatively robust. So, in my view, with American Railcar we have a business that's operating in an industry that is subjected to the business cycle in the short term but is expected to grow well over time. Financial snapshot. The short-term exposure to the business cycle mentioned above is evident when you review the financial history here. Revenue is obviously much lower in 2017 relative to 2015 and earlier. Thus, an investor in this business would be wise to understand that this business is directly impacted by the short-term demand for the company's two primary products, tank cars and covered hoppers. I should also mention that the reason for the spike in net income in 2017 relative to full year 2016 is the fact that American Railcar enjoyed a $75.9 million tax benefit in 2017. Absent that, net income would have been down in 2017 by about $6.6 million, holding all else constant. American Railcar breaks down its revenue by its three primary business segments: manufacturing, leasing, and services. Of these, leasing is the most interesting to me for a host of reasons. First, it is the most stable and tends to flatten out the volatility we've seen. Significantly, the lease business segment has been much less volatile than the other sources of revenue. Second, the company is investing more in its growing railcar fleet. As of the end of March, the lease fleet consisted of 13,326 railcars, up from 11,869 at the same time last year. The lease utilization rate is around 98% at this time, which supports the notion that this is a stable business. Also interesting is the fact that the backlog has grown robustly during the first quarter of 2018, and the financial results reflect this fact. This is significant because the backlog gives a great deal of visibility into future revenue. Also significant is the fact that fully 8% of the current backlog is dedicated to the lease fleet, indicating that the company understands the importance of this part of the business. Source: investor presentation slide. Turning very briefly to the capital structure, I'm not concerned about the level of long-term debt here for two reasons. First, the level of debt has dropped dramatically over the past few years. Long-term debt is down about 11% since 2015. Second, about 81% of the long-term obligations are due after 2022, suggesting that there's not much fear of an immediate liquidity or solvency crisis anytime soon. Finally, the company has a fleet of unencumbered rail cars that can act as collateral for loans in the event that's necessary. Management seems to have treated shareholders relatively well, in light of the fact that they have returned just under $244 million to shareholders since 2013 alone. $86 million of this return has come from stock buybacks, and the balance from dividend payments. In my view, this is a critical necessary precondition, given that the absence of a shareholder-friendly management almost guarantees a loss. The combination of a generous dividend and low price means that the shares are currently yielding about 4% annually. Source: company filings, author calculations, margin figures. Source: company filings. Modeling the dividend. Its recent financial history offers some indication about where the company may be heading, but investors are obviously more concerned about the future than the past, for obvious reasons, so I must spend some time forecasting a future price. In order to do this, I hold all variables constant but what I consider the most important single variable. In this case, I think the dividend is the single most critical variable, so I'll hold all else, i.e. yield constant, and grow the dividend. While the dividend has flatlined over the past few years, over the past 5 years, dividends per share have grown at a CAGR of about 45%. Although growth has been sclerotic, the low payout ratio suggests that there's room for an increase in the future. For my modeling exercise, I'll assume an 8% growth rate over the next 5 years. I consider this to be a very conservative approach to modeling the dividend, but I prefer my surprises to be positive ones, so I'm comfortable with the more conservative path. When I forecast this dividend growth, I calculate a CAGR for the shares of just over 10% over the next 4 years. While I don't think the dividend growth will be as smooth as I've outlined in my forecast, I do consider it reasonable to expect some dividend growth, which should impact the share price. Source: author forecast. The stock. As I've said repeatedly, and no doubt tiresomely, investing is as much about buying decent companies at the right price. It's possible that a great company can be a terrible investment if the price is too high, and the reverse is also true. Thus, part of the art of this is finding a great company that most other people don't like. At the moment, the premium attached to a future dollar of American Railcar's earnings is such that it's obvious to me that most other people don't like the name. I think we would be wise to take advantage of the crowd's short-sightedness. Source: Guru Focus puts. To enhance yield. At the time of writing, shares of American Railcar are priced at $39.67, and the shares currently sport a dividend yield of about 4%. September put options with a strike of $35 are trading for about $1.10. An investor who is still not interested in buying can sell some September puts with a strike of $35 for $1.10. This will obligate them to buy at a price 11% below the current level. At that adjusted purchase price of $33.90, the yield on the shares will be 4.7%. This 4-month commitment is not a bad approach to going long American Railcar. If I'm correct and the shares rise from here, investors will simply pocket a free $1.10. If I'm wrong and the shares languish, investors will receive a very decent company at an even better price. Conclusion: although there are some challenges here, primarily relating to the business cycle, American Railcar is an excellent investment with a very favorable yield. There will be some chop in performance over the coming years, but for investors with a longer-term horizon, this is a company that will not disappoint in the coming decades, in my view. Investing is about finding decent cash flows, trading at very decent prices, and American Railcar meets those criteria. Finally, for those too skittish to commit at these levels, there is an interesting way to participate via the options market. Whatever route an investor wants to take though, they should do it fairly soon before price and value inevitably meet. Disclosure: we have no positions in any stocks mentioned, but may initiate a long position in ARII over the next 72 hours. I wrote this article myself, and it expresses my own opinions. I am not receiving compensation for it, other than from seeking alpha. I have no business relationship with any company whose stock is mentioned in this article.